Este último que hemos comentado, dato de PMI. Y mientras tanto, un mercado que parece que se está tomando bien algunos datos como los de inflación de Estados Unidos. Vamos a saludar a Kevin Thozet, que es miembro del comité de inversión de Carmignac. Kevin, good afternoon.
Hello.
Kevin, thank you so much for being in Negocios Televisión. It's a pleasure to have you here. I wanted to ask you about your outlook for the second half of this year, 2023. Do you think central banks will be able to change its course due to recent inflation readings, which have gone down in many countries?
Well, clearly, the first 6 months of this year has taken investors by surprise. We saw the resilience of economic growth in the developed world, while on the contrary, China recovery was below expectations. And what this has led to, we have seen that stocks markets have been on levels which are even higher than last year, or even higher for the several past years. For the second half of the year, what we expect is things to be a bit more contrasting. Why that is? Because we are seeing, and we will be seeing even more, the surge in effects of the monetary and of the fiscal tightening. With regards to central bankers, more specifically, well, the past month, what we have seen is a shift by central bankers. Why that is? Because inflation is proving more persistent than expected. Where you are in Spain, typically, headline inflation is indeed slowing very significantly, 1.5, 1.6%, but core inflation is still at 6%. And it's a similar story across the region. So that's one conundrum. The other conundrum is that, in fact, because of the huge excesses that we have seen, along with the yield curve inversion, so the more is being priced on the short-term part of the yield curve, so the more tightening, the more it's weighing on economic growth, so long-term bond yields are falling. And this has had impact on the usual transmission mechanism, because real estate is holding pretty well, and long-duration assets, as we have seen on equities, are holding well, quite well as well. So what we do expect for the second part of this year is, in fact, more, we are probably we'll see a couple of more interest rate hikes in the US, in the Eurozone, and then that we will stay on a plateau until the, I'd say, economic growth does get really bit by these tighter monetary conditions.
Speaking of central banks, in your report, Kevin, you have a very interesting idea. You say central bankers will face more and more opposition from politicians as we get closer to 2024. Which effect will this have towards central bankers? Do you think that there is any chance that they can feel pressured by politicians? Because, for example, in Italy, we've already seen Giorgia Meloni, the Prime Minister, criticizing the ECB for hiking rates.
Yes, I mean, as I was mentioning, there are different stages of monetary policy transmission. And the first one is tighter financing, tighter credit conditions. And that's the one in which we are now, and it's clearly at play. We're seeing very low credit growth in the euro area, notably. Then comes the second step of the monetary transmission, which is the impact on the real economy, on the real activity. And then the third step is slower or lower inflation. So the first step is working, tighter credit condition. The second one is coming. And when we're looking at, what's happening on the manufacturing front, it's really pointing at slower economic growth. But the risk is that as we approach to 2024, we will see this second step, also the negative impact on the real economy, but those tighter monetary conditions impacting economic growth and impacting the jobs markets. And so the risk is, how will politicians react in the face of this? In the US, what we will likely see, and that's, the question is still out there, it's either we'll see Mr. Powell or the US Central Bank following the steps of Volcker, so keeping these very tight monetary conditions, high interest rates, and looking at the jobs markets worsening and worsening. And this will come with a significant contraction of the economy, or we will be seeing a pivot over the first half of the year, while inflation in the US, core inflation, is still at 3%. What is the impact of this? This means higher inflation or higher inflation expectations, I would say. So that's the risk for the US. In the euro area, as you were mentioning, we are already seeing some politicians which are being quite vocal against the ECB. And the risk in the euro area is a bit different, because in the US, the Fed can hike rates very high and then cut them very significantly. In the euro area, the risk is a bit different. The risk is very much tilted towards over-tightening, the European Central Bank doing too much. And then they would have to reverse because of cracks happening and potentially monetize the debt of those most indebted countries in Europe. And that's, I would say, politically, it's the most difficult outcome for the euro area. So what does this lean into? It means that the US can go even further and then cut rates and potentially feed into inflation expectations. While in the euro area, it means that we are very much approaching, I'd say, the end of the tightening cycle, and that interest rates will stay on a plateau because we will see the hawks at the European central banks fighting against any form of cuts or any form of easing down the line.
Analysts have been saying it is the moment to invest in fixed income since the end of last year, 2022. It's true that bonds are paying right now 4 or 5% in coupons. However, prices have not yet recovered. When do you think this might happen, the recovery of prices in bonds?
Yeah, well, I mean, I share the concerns of investors and concerns of holders or savers. But in fact, the recovery in prices has started. It has started modestly, like the recession. It's taking its time to recover. But if I'm looking, for instance, at Spanish government debt index, it's up by 1% in price terms and 2% in total returns. So, we are starting to see some recovery. As I mentioned, we are approaching the end of the tightening cycle, and this will likely what will trigger, I'd say, more of a rally in prices for bonds. So how do we approach this? How do we invest in such an environment? We prefer intermediate to long-term interest rates. So let's say 10-year maturities, both in the euro area and the US. Why that is? Because those 10-year maturities serve two scenarios. One is either we are seeing economic growth falling and falling more significantly, what everybody has been expected, but which has not materialized. And this will help those bonds issued by well-rated issuers because they act as safe havens, and the price of those bonds appreciate when investors are seeking defensive assets. So that's the first scenario. The second one is that we have a more resilient economy and we have more tightening because inflation is more persistent. And what does this mean? It increases the risk of over-tightening and hence of a hard landing of the economy, which will weigh on long-term bond yields and hence support the price of those bonds. And in fact, we have a similar story on credit markets. Beginning of January, so beginning of this year, we had credit spreads at around 500 basis points for high yield indices. And now they're lower, 450. So we have seen this modest, but still price appreciation by 2%. And carry yield is doing the rest. And so we have, so far this year, like a high yield index at around 5% in total return. So this is starting to materialize in those bonds, in those credit markets where we prefer to be invested, in those bonds with higher coupon. Because in fact, the bonds which were issued over the past 3 years with a very low coupon, it will take time for them to recover and to go back to par value. So where do we invest? In fact, in credit markets, in the higher yielding part of the credit markets. And why that is? Because again, we have high carry, close to 9% in the US, 7% or 8% in the euro area. And in fact, those bonds or the credit markets are prepared for a slower economic growth environment. Why that is? Because what we call the bond vigilantes, I'm using a bit of Spanish here, they're called bond vigilantes for a reason, because credit investors are careful. We have to prepare for the worst because the asset class is very asymmetric. So in fact, in the current environment, even if we have a significant pickup in default rates, similar to the crisis we saw, or through the period we saw between the great financial crisis and the European sovereign bond crisis, even with those levels of their defaults, on average they were at 5% over that period. Even in this environment, credit investors would be making money. And why that is? Because when those bonds are defaulting, there's a recovery value, around 40% of the value of the bond. So we are losing money, but we are catching up on the recovery value of those bonds. And because we have a very high yield, a very high coupon, as I mentioned, 8.5, 9%, 10%. So even in an environment where we're having a pickup in default rates, investors and credit investors can have returns which are online with long-term annualized equity returns. So that's very, very important and a very key asset class and market segment to be invested this year.
Kevin, one very quick last question, because we only have like 30 seconds left. In the stock market, there has been a rally over the last few months. The big question is if this rally will extend over the summer or not. What do you think?
Well, during the summer months, July is usually a good month on a seasonality basis. So, and again, I think the first 6 months of this year have to, call for humility by investors. There was a famous investor in America who's called Peter Lynch. And what does he say? That in fact, there's far more money which has been lost by investors preparing for corrections or trying to anticipate kind of a correction than it has been lost in corrections themselves. And that's, I think, an important factor. I would like to quote another famous investor whom I have the pleasure to work for, who's usually very often says, where do we go from here? So what do we believe? We believe that in this environment, it's important to keep some exposure to equity markets. We have around 35% of net equity exposure in cross-asset funds, so in big books, and below the surface, stick to or invest on quality companies, quality growth companies, which have kind of a measured cyclicality embedded into them. The most favored sectors in relative terms, I'd say staples, healthcare, which are on top of which have a catch-up potential. They are lagging so far this year, they can catch up. And there are all the sectors, I'd say, for instance, on the industrial side, which have a business cycle which is kind of faring in a different way from the global economy. And that's notably the case, for instance, in aircraft suppliers or aircraft manufacturers, where there are huge order backlogs, so which sector business cycle can differ from the global business cycle.
Kevin Thozet, miembro del comité de inversión de Carmignac, thank you so much. It's been a pleasure, Kevin.
Muchas gracias. Adiós.